Good morning, everyone. Thank you very much for joining us today. My name is Ian Anderson. I'm co-head of investments at Sygnia. And today I have the privilege of speaking to you about a new range of funds at Sygnia, a range of funds called the Sygnia ZenFunds range. Now, as the name implies, these are low-risk funds designed to help us keep calm in these turbulent markets. And we know we're dealing with incredibly turbulent markets at the moment. Just yesterday, the US markets had their biggest one-day fall since 2022. And on Thursday of last week, the Bank of Japan cut rates for the second time since 2007, and the Japanese market fell 20% over the following few days. It did recover 10% yesterday, but incredibly volatile times. So the Sygnia ZenFunds are just there to remind us that the world and the markets in particular are not always as turbulent and upsetting and as chaotic as the news and social media make it out to be. And when we're constantly bombarded by all this volatility, all this negative news, it impacts us emotionally, and it can actually then lead to bad investment decisions. And we've seen this in the run-up to elections this year, in the general elections in South Africa in May of this year. A lot of investors were phoning Sygnia wanting to get out the market, wanting to sit on the sideline. So they were disrupting their investment strategies based on the emotions that we're feeling because of the chaos that they were reading about. So these Zen funds, again, they're very low-risk funds, very much focused on the generation of income, but very much focused on the management of risk. And I'll take you through the various funds. But it's very important to note that all these funds have an established track record. So some of them have been running for upwards of 5 years, and a track record that we're very proud of. And I'll go through that in some detail. And all of the funds are Reg 28 compliant. So they're perfect for either pre or post-retirement planning. And I'll go through the benefits of each individual fund. But the 4 funds we're going to be speaking about, we've lined them up from a risk point of view. So the lowest risk fund, the Sygnia Money Market Fund, then the Sygnia Enhanced Income Fund, then the Sygnia Skelton Balanced Absolute Fund, and the Sygnia Life Income Maximiser Fund. And the other thing to note is that the first 3 funds are unit trusts. So the Money Market Fund, the Enhanced Income Fund, the Skelton Balanced Absolute Fund are unit trusts. So they're available to any investor, no matter what investment vehicle that they are using. So it's available if you're in a direct investment, a tax-free savings account, a retirement annuity, a living annuity, an endowment, preservation fund, an investment policy. Anyone can invest into these funds. The one fund that does stand out is the Sygnia Life Income Maximiser Fund. And as the name implies, that fund sits on the Sygnia Life license. So it's only available to investors in retirement annuities and living annuities and investment policies. But it's really designed for retirement annuities and living annuities. But I'll go through that in some detail when we look at the individual funds. The other thing to note is we have a number beside each fund, and that is what the funds are currently yielding. So again, these funds are very much focused on generating an income, generating a yield. But it's important to note that we know a total return of any investment is made up of 2 things, of income and capital growth. And so these funds are for investors that prioritize the generation of income over growth, taking on extra risk. But as we go up, so you can see the money market fund is currently yielding 9%. The enhanced income fund is yielding 10.9%. And the Skelton Balanced Absolute Fund, so it's a very diverse fund, still a very low risk fund. It's yielding 6.6%, but it sits up there on that higher risk, higher return spectrum because it does have an element of growth in it. And the same goes for the Sygnia Life Income Maximiser Fund, currently yielding 10.6%, but it is for a longer term investment horizon, and there is an element of extended risk in there, which we will go through in some detail. And just to quickly look at the asset allocation of the various funds, so you can see where they sit. It's no surprise, the Sygnia Money Market Fund, 100% invested in SA cash. The Enhanced Income Fund is 100% in SA income assets. And then the Sygnia Skelton Balanced Absolute Fund, you can see, is quite a diverse fund. So again, emphasizing still very low risk. It's got 60% of its asset in South African income assets, so 30% in bonds. It's got 10% in inflation-linked bonds and a further 25% in enhanced income in South Africa. But it also has a 10% exposure to South African equity, which is where it introduces an element of the growth, and 15% exposure to offshore equity. So still a very low-risk fund, but a diverse approach to the low-risk investing, which is a diverse approach to generating income. And then finally, the Sygnia Life Income Maximiser Fund. It's currently sitting 60% in nominal bonds and 40% in income. But as you'll see when I explain that fund, we can move between asset classes there. But that is where the fund is currently sitting at the moment. And at the moment in South Africa, we know there's plenty of reasons to feel unsettled. And that's why we think the ZenFund range is very appropriate for the current environment that we're living in. But we know in South Africa, we're living with a lot of uncertainty. We're living with daily load shedding, although that seems to hopefully has slowed down quite a bit. The recent elections, even though the outcome has been received quite positively, there was a lot of uncertainty leading up to that, which was affecting markets. We know we're living with high interest rates, and I'll talk about how these funds are particularly suited for the high interest rate environment. We know the government is running very large, unsustainable budget deficits, leading to a large debt burden in South Africa. And we know that the government is spending too much money in unproductive parts of the economy. So they're spending too much money on the likes of social grants and not enough on infrastructure that are going to help generate jobs, it's going to help generate growth. And if you've listened to me speak in the last 10 years or so, you've heard me speak repeatedly about this low growth environment that we're living in and why we have to position our funds for that. And I saw this slide. This is from our chairman, Sygnia's chairman, Professor Haroon Bharat. If you watched his webinar of a week or two ago, he presented this slide, and I thought this was it's a somewhat depressing slide, but it's a very illustrative slide. It shows the real annual GDP growth over the last 30 years, essentially. And you can see South Africa way down there on the right at 1.2%, so very much underperforming its potential and underperforming its peer group of other developing economies. And really what is disturbing is that our 1.2%, that is 3.7 times lower than the upper middle income average of 4.4%. And it's even below the lower middle income average of 3.1%. So very much a story of under delivery, under promise. And one of the conclusions from Professor Bharat is that South Africa is trapped in this growth trap, that we're unable to get out of it. And it's something that's going to persist with us for the next foreseeable future. And again, these Zen funds are particularly well positioned for the circumstances that we're facing in South Africa. But before we fully understand what we're facing in South Africa, we do need to look externally. And we know that, yes, we get bombarded with the negative news domestically, the corruption, the load shedding, and we think that is what's largely impacting our market. But the South African market is largely impacted by external factors. And when I say external factors, I mean what's going on in the US, and particularly what's going on at the Federal Reserve in the US and their interest rate scenario. So this chart just shows you inflation and interest rates in the US going back to 2017. So on the left-hand side, you can see both interest rates and inflation were very benign, very contained, very controlled. Inflation was sitting around 2%, below 2%, and interest rates were incredibly low in the US. And that's what helped growth around the world. Low interest rates is great for growth. And then, of course, we know first quarter of 2020, the COVID pandemic hit. And the initial response of the Fed was to cut interest rates down to zero to help save the economy. And that seemed to work to some extent. But as the impact of the low interest rates and also the impact of what went on during COVID, inflation started to spike. And we saw inflation run up in the US to above 8%. And in response to that, the Fed had to then start hiking rates, which had a very negative impact for us in South Africa. When they hike interest rates in the US, it leads to a strong dollar generally, and that is very bad for growth in the rest of the world. It's very bad for emerging markets and very bad for South Africa, very bad for our rand, and we feel that impact here. So the Fed had hiked rates very aggressively. Inflation did start to come down, and it came down quite quickly, which is great, and people got very excited about the potential that they can start entering a rate cutting cycle. But now we see that inflation on the right-hand side there, that line, you can see that inflation is persistently sitting at 3%, just below 3%, which makes it very difficult for the Fed to cut rates, but I will speak to that. But what impact does that have for us then in South Africa? Well, it's very hard. I'm just going to switch to this next slide. It's very hard for us to cut interest rates while rates remain so high in the US. So this is the top line here, is the South African 10-year bond, and you can see that it has remained persistently high. It spiked up in the 2020 COVID pandemic, but has remained very high. And that's one of the things we do have to live with. And that's one of the things that the ZenFunds do take great cognizance of. But the other factor that we like to highlight in this chart is that you can see the line at the bottom, the dark solid line, the stepped line, that is inflation in South Africa. And I don't want to say inflation's been benign because it's still quite high, above 5%, but it's very much within the band of the Reserve Bank. And that's created a fairly stable environment in South Africa. So once they do start cutting rates internationally, we can expect our rates to start to come down. But over the last period of time, and what the ZenFunds have been able to take advantage of, is we have very high real interest rates in South Africa. So when you take the yields minus inflation, we wind up with a very high real yield. And as long as you think that the government is going to be in a place to repay you the money that they owe you on these bonds in 10 years' time, which we do believe, then that is a very attractive yield for you to achieve within the funds. So again, how does that impact us in South Africa? Well, while rates remain high in the US, that's good for the dollar. It's very bad for emerging markets. So that remains a real headwind. And certainly we cannot start cutting rates until we see them cutting rates in the US. And of course, while all of this is going on, there's an election happening in the US, and one of the probable outcomes is that Trump is reelected, and there's a Republican sweep in the Congress and in the Senate, and the Republicans will then be in a position to implement their America First type policies, which again will be quite good for markets, particularly in the US, but it will lead to a stronger dollar in the short term, which again is just a headwind for those of us in South Africa. So this is one of the factors that we do have to live with. And it's one of the things that the ZenFunds deal with very, very nicely for investing. And then just finally looking at the potential for interest rate cuts in the US. So the market got very excited at the start of the year. If you think back to December, at the end of last year, the market got very excited. The Fed was going to be able to cut rates, but then of course, inflation remained persistently high. And these interest rate cuts got pushed out. And then one of the reasons for the volatility in the past week is the US released their jobs data on Friday, and it was a very disappointing data point, which really focused people's minds on the potential for the US slipping into a recession, which would again probably lead to a global recession, very bad for global growth, but it has increased the likelihood of interest rate cuts in the next 6 months. So the market is fully pricing in that the Fed can start cutting rates when they meet in September, and for 25 basis point cut and another 25 basis point cut in December. But now with the bad data point that we saw last week, the market's starting to get really excited, and potentially they're going to cut 50 basis points in September, or maybe they'll even cut in November. So that is really having a big impact on the market, big impact on the bond market. And that's partly why we've seen this incredible level of volatility in the last few days. So with that as the backdrop to the environment that we're operating in, I'm going to now go through the individual ZenFunds and how you may be able to use them. And one of the things is I spoke with Lorna Knutze, our head of retail. I'm sure many of you are very, very familiar with her. And I spoke to her about how our clients are using the Sygnia ZenFunds themselves in their particular circumstances. So the first fund is the Sygnia Money Market Fund. It is a unit trust. It's a high quality fund that we manage ourselves. So that's another thing that we're very passionate about. And you would have heard me speak many times about the importance of low fees. And one of the ways we get to keep our fees so low is we manage the core portion of the low risk portions of our portfolios ourselves. So we manage the Sygnia Money Market Fund ourselves. It's a highly liquid, high quality portfolio. And speaking to Lorna, it's best suited largely for people who are waiting to enter the market. So they don't want to put a lump sum into the market, so they're going to phase the money in. The money could sit in their bank account and earn a very low rate of interest, or they can put it into the unit trust as they wait to go into the market and earn that very high 9% yield, as we saw. So while still having very good access to your cash, it's a daily liquidity. So it's a very, very appropriate fund. And then she also said that people use it when they take money out. So maybe people have been saving to buy a new car, buy a new house, and they take the money out of their investment account, but they're not ready to use it. They don't want to put it in their bank account. They put it into the money market unit trust. So that's the first fund. And then just to let you see how it's currently comprised, so I do want to keep emphasizing it's a high quality fund, highly liquid. A third of the fund is invested in very short term government instruments, so highly liquid and very high quality. And a large majority of the remainder of the fund is invested in the large banks in South Africa, and again, in very high quality paper. So not the risky part of the market. We don't want to take excessive risk in this fund at all, while maintaining appropriate liquidity. So of course, how has the fund performed? Well, we're incredibly proud of the performance of the team that are managing this fund. You can see over 1 year, the fund has returned 8.9% to the end of June. I know we're sitting in August, but we couldn't get the numbers updated, unfortunately, to the end of July. 8.9% against the category median of 8.7%, and it's ranked in the top third, 11 out of 37 funds. Over 3 years, a 7% return, ranked third out of 36 funds. Again, fantastic, while taking very minimal risk. 5 years, a 6.4% return, reflecting the lower interest rate environment of 5 years ago, against the median of 6.2 and ranked 4 out of 31 funds. And since inception, it's ranked 8 out of 28 funds. And at the bottom table, you can see all for the very low fee of 0.25%, or 25 basis points, a quarter of a percent, a very low fee. And again, you've heard me speak about the importance of fees to your long-term investment success, and we're very proud to offer this very low fee. So that's the first fund in the ZenFund range. The next fund is a fund that's been around for over 5 years now as well, the Sygnia Enhanced Income Fund. A fund we're very proud about. It's a slightly higher risk fund, very much still focused on the generation of income and of yield. And as you saw, it's currently yielding 10.9%, but it does so without taking on interest rate risk. So as we saw, looking at those interest rate charts in the first few slides, interest rates are highly volatile. And we know that the price of a bond is inversely related to the interest rate. So if interest rates go up, the price of the bond goes down. And if interest rates fall, the price of the bond goes up, which can create a lot of volatility, which a lot of people don't like. So again, speaking to Lorna, people had a requirement for a steady income stream that was not going to fluctuate as interest rates moved up and down, was not going to be negatively impacted by interest rates. So we constructed this portfolio in a very special way. Sorry, just one moment. I am mute. I don't think so. I'm assuming someone's just told me I'm on mute. I'm hoping I'm not on mute at the moment. Sorry. So back to the fund. This is a fund that's investing into floating rate instruments. So there's no interest rate risk being taken in the fund. And again, we manage the core portion of the fund ourselves, which is highly liquid. And we'll take a look at how we do that. And then we outsource a portion of the fund to specialist asset managers, where we can pay the higher fee because we're managing the low risk, highly liquid core portfolio ourselves. And again, this fund is used for people who need a steady income without being negatively impacted by fluctuating interest rates. So as we can see on the next slide, how we construct the portfolio on the left-hand side is the highly liquid core portion of the portfolio that we manage ourselves. We don't want to have to pay people to manage this because it is a fairly easy portion of the portfolio to manage, but it's an important component because it's what enables us to provide the liquidity. This is a unit trust, so we have to provide daily liquidity, although we don't recommend people to use this fund if they need to get their money in and out, because it is a higher risk fund. So you certainly have to have a longer time horizon, but we are able to provide that liquidity by managing it ourselves. And then very importantly, how we achieve that excess yield is we outsource a portion of the fund to external managers who have the specialist skills to invest in the illiquid portion of the market and capture the liquidity premium that you get in that portion of the market. And we're currently using Taquanta, Ashburton, and Alawani. And they are highly specialized managers who have special skills required in order to put these structures together and to manage these portfolios on behalf of our clients. And then we manage to put that together and create a fund that would not otherwise be available to retail investors. So again, we launched this fund 5 years ago, and we're incredibly proud of the way it has performed. And if we look at how the fund is constructed, close to 40% of it is in this low-cost, high-quality core portfolio, and then we outsource the portions to the external managers. And you'll see there is a 6% allocation to nominal bonds. So again, we don't want to take a lot of interest rate risks, but when we feel that the yield curve is high enough and the risks warrant it, we can put a small allocation into nominal bonds to take advantage of those potential declining in interest rates. And at the end of June, we had a 6% allocation to nominal bonds. We've since reduced that as those interest rates have come down. So it's a way just to benefit from that but it's just a very small tactical position. It's never going to be a large portion of the portfolio. And then just to emphasize that, you can see 88% of the portfolio is invested in these floating rate instruments, which adjust as interest rates go up and down. So your portfolio is not negatively impacted. And then a very small portion, 10%, is in fixed rate notes, and then the rest in highly rated cash instruments. And then the final slide before we look at the performance is just, again, I keep emphasizing it, managing the risk in this portfolio, managing the quality of the portfolio. We are not investing in high-risk assets within this portfolio. So on the left-hand side, you can see the rankings, and the majority of the portfolio, close to 90% of the portfolio, is invested in senior debt, bank sub-tier 1 debt, and secured debt, which is just, it's very high quality. It's not risky instruments at all. And then the asset allocation on the right is just a breakdown, further breakdown, but just showing the majority of the fund is invested in these floating rate notes, so you're not impacted by the fluctuations in interest rates. And then how has this fund performed? Well, again, we're incredibly proud of the performance of this fund, 10.9% over the past year. And that's to the end of June in an environment where interest rates have come down quite aggressively in South Africa. So this fund, on a relative point of view, you would expect it to start to lag behind its peers, but it is still generating a very good return and a very high yield, a very good income, despite the environment. So 10.9% return to the end of June versus 9.9 for the category median, giving it a ranking still in the top quartile, 33 out of 199 funds. So it's done incredibly well. Over 3 years, a return of 8.5, ranked 9 out of 105 funds, and over 5 years, a 7.8% return, and a since inception return, so it's just over a 5-year return of 8%, giving it a since inception ranking of 17 out of 81, all while producing incredibly steady returns with very low volatility. And that can be seen in the final slide. So this is your since inception, your standard risk return plot of the Sygnia Enhanced Income Fund against the peers in the category. And you can see where we're sitting up here in the top left, meaning we're generating one of the highest returns with one of the lowest risk. With amongst the lowest measure of risk, standard deviation. So the volatility of this fund is incredibly low, and managing still to generate those returns and generating that income for the client. So a very, very important fund in the Sygnia ZenFund range, and a very popular fund with our clients, according to Lorna. And then the next fund is the Sygnia Skelton Balanced Absolute Fund. So this fund sits in 2 ranges. It also sits in our Sygnia Skelton Balanced range, but it is our lowest risk fund in the Sygnia Skelton Balanced range. And again, Lorna says this fund is very popular with clients who do want to take on a bit more risk. So if you recall, when we looked at that risk return, this fund is currently yielding 6.6%, but it's still expected to generate a higher return, and that's because of the risk that it is taking in growth assets within the portfolio. So there are people, lots of clients, who still want a low risk fund, but are interested in taking on a little bit more of that growth risk. And this fund is very suitable for them. And as we've seen, and we can look at here, it is a very diversified fund. So I still want to emphasize that it's a very low risk fund, 60% invested in South African fixed, 30% in South African bonds, 25% in enhanced income in South Africa, and 10% in inflation-linked bonds. So still 60% of that fund, plus the cash, 60% of that fund invested in very low-risk portfolios, but it does have a 10% allocation to South African equity, 15% allocation to offshore equity, which does introduce that element of risk, and it has an over 20% exposure to offshore assets as well, which introduces the currency risk in the portfolio, which is part of what we need to manage in the portfolio, but that does up the risk in the portfolio. So even though it's a very low risk fund, it is taking more risk and is therefore more suited to a longer term investor. And how has this fund performed? So it doesn't have as long a track record. It was launched just over 2 years ago. But you can see over 1 year, 10.9% return, so very similar to the Enhanced Income Fund, and against the category median there of 10.1%. And I should highlight the very attractive fee as well, 40 basis points, 0.40%, which is the same for all of our Skeleton Balance funds. So amongst the lowest fees in the industry for a global balance portfolio. So a very, very attractive fee, and a since inception return of 9.2% against the category median of 6.6%. So again, a very important fund in the Sygnia ZenFund range, a diversified approach to balanced investing, while still maintaining the characteristics of a very low risk fund to help give you that peace of mind, help everybody sleep at night. Then the final fund, and this is the one that does stand out in the range, is the Sygnia Life Income Maximiser Fund. So again, it sits on the Sygnia Life license, so it is only available for retirement annuities, living annuities, preservation funds, and investment policies, but it is really designed for living annuities and retirement annuities. And it's for clients who do, again, speaking to Lorna, it's a very, very popular fund. It's people who want to maximize their income without worrying about timing the market. And so they're willing to be in the market for quite some time. And as we go through the philosophy of the fund, we do move between asset classes. We don't do it very often, but we take a look at the yield curve. We take a look at the yields currently being offered on South African bonds, in the enhanced income space, in the property space, in cash and inflation-linked bonds. And we can move the asset allocation of the fund to take advantage of what we think is going to be happening in the market. And when we look at the returns, you can see that the fund has produced exceptional returns. So it is very good for clients who require that high income, but they're willing to be in the market for longer periods of time and suffer through the volatility, slightly higher volatility than you will be getting in the other funds, and particularly against the enhanced income fund, which invests in those floating rate notes. You're not taking that interest rate risk. In this fund, you're very much exposed to the interest rate risk. But again, that's why it has that higher expected return over the long term. And one of the things that we do look at in putting the fund together and moving tactically between the asset classes is the shape of the yield curve. And I won't go into too much detail, but this graph just is one of the things that we look at. It takes the yield on the 10-year bonds that we saw previously, and it subtracts the yield of the 2-year bond. So it just gives you an idea of the slope of the yield curve in South Africa. And what is that telling you? And you can see for many years on the left-hand side of the chart, leading up to the COVID pandemic in 2020, that yield curve, I wouldn't say it was flat, but it was fairly benign, fairly low. And then that shot up during the COVID crisis of 2020 as our interest rates shot up upwards of 15% for periods of time. And the yield curve became incredibly steep. And that became a very attractive investment opportunity for a fund like the Sygnia Life Income Maximiser Fund. And we can see that on the next slide. This is how we move the asset allocations. You can see it's quite stable. The bulk of the fund is currently invested in South African bonds, nominal bonds in South Africa, but we have at times had allocations to property, and we currently have a small allocation to enhanced income and other assets. And that is how we generate the high yield expected of investors in this fund, but it does introduce another element of risk. So again, it's just for those investors who are comfortable to take that risk within their long-term retirement portfolio. And then if we look at the performance, this is how the fund has performed. It's got a just over 3-year track record, performed against the various asset classes. And the fund itself is the dark blue line. And you can see that over any given time, it is outperforming the majority of the underlying components, which means we're successful in our movement based on movements in the yield curve between the asset classes. So over 1 year, well, it's given a very high return, I think 13.4%, as we'll see in the next slide, and against the various asset classes. And over 3 years, it's outperformed the majority of the asset classes, just slightly behind the enhanced income fund. So again, a very, very successfully managed portfolio. And this, we can see the performance. Again, this is on the life license, so there's no peer groups to compare it to. But again, very attractive performance over 1 year, 13.8%. So that's just reflective of its investment in nominal bonds. As I said, when those interest rates come down, as we've seen particularly in the last 2 months, the price of those bonds go up. So the total return goes up. So this fund is a very nice return of 13.8% over the past year. Over 2 years, that's an 11% return. And over 3 years, 8.3%. And since inception, it's just close to 4-year total history, it's a return of 9%. And just to emphasize again, it's currently yielding 10.6%. So very attractive for those investors seeking that high yield, but very happy to take on the extra volatility. And the management fee, because it sits on the life license, is slightly higher, but it's up 50 basis points, still a very attractive fee, or 0.5%. So I've whipped through that. That is 30 minutes. That gets me to the end. Those are the 4 funds in the Sygnia ZenFund range. So again, just to emphasize, that these are funds that have an existing track record. The range is new, but these funds have been around, a proven track record, a consistent track record, and designed, they're low risk funds, but designed to generate income and provide varying ways to do that, dependent on clients' appetite for risk and appetite for volatility. So a fund like the money market fund, taking on very little risk, highly liquid, high quality, that gives you easy access to your cash. The enhanced income unit trust, you remember, does not take any interest rate risk, so majority invested in floating rate notes, but again, producing very consistent, steady returns with very little volatility, but very high levels of yield without taking the interest rate risk. So again, very attractive to investors requiring that steady income stream. The Sygnia Skelton Balance Fund does stand out as well. It's the diversified fund, so it has exposure to most asset classes, including that 20% to offshore, but still a very low risk fund, aiming to give you a yield, but doing so by tapping into diversified sources of yield and diversified sources of growth. And again, a very popular fund, looking for those investors who are comfortable to take on a little bit extra risk. And then finally, the Sygnia Life Income Maximiser Fund, the one fund that does stand out, only available on the life license. So only available if you're in a retirement annuity, living annuity, endowment, or life policy, but again, very much designed for investors in living annuities and retirement annuities. So thank you for listening. Happy to take some questions now. I hope you found that useful, that these funds, again, very much designed to help people in these incredibly turbulent times, lots of volatility, lots of negative news flow. We just want to help you keep calm and invest on. So with that, I'm going to take a look at some questions. So could you please explain, this is Ms. Phillips, how expected reduction in interest rates will affect the performance of the Sygnia Enhanced Income Fund? Will the reduction have an immediate effect? The short answer is it won't have an immediate effect because we're managing to invest in assets at the moment that are yielding that 10.9%. So irregardless of what's going to happen in the coming year, we would expect those assets to give you that yield of 10.9%. Of course, if interest rates keep coming down and we have to purchase new instruments, we are going to be purchasing them at lower interest rate levels. So the total yield you'll be getting going forward will be coming down. But again, it's going to be incredibly steady, incredibly consistent, as we've seen with that 5-year track record, that even through the volatility of COVID, the fund managed to keep producing that steady return and market-beating return. So thank you for that question. And Mr. Malherba is asking, in an environment of declining interest rates, which fund return will decrease the most? Money market fund or enhanced income? Well, if interest rates are coming down, the prices of bonds are going to go up. That's the easy answer. So the income maximizer fund is going to have the best expected return. I think the one that is going to decrease the most or decline the most, and it's not going to be a negative return, it's just going to be lower than previously, will be the money market fund. It's the fund that invests in the shortest rate notes, so it has to keep reinvesting at a quicker pace, so the effect will be felt more immediately in the money market fund. As I said, the enhanced income fund, the effect will be much more spread out. And then Jaywant asks, when will the COVID impact settle for markets in SA and the world? It's a great question. We're dealing with the lingering effects. And of course, there's lots more going on in the world, but those disruptions, the supply side disruptions, that deglobalization effect, that's going to be felt for a long time. So when COVID hit, and you would have heard me speak about this before, companies around the world are very happy to have their manufacturing arms, their supply chains around the world because it was cheap. But when COVID hit and suddenly those supply chains get disrupted, they felt the impact very severely. And even though it was going to cost more, people wanted to bring those supply chains closer to home. So we had this deglobalization effect, the onshoring effect, people setting up factories in their own countries. So that effect is going to carry on for quite some time. And then, of course, so inflation is staying high because of these supply side disruptions. And then we had other factors that we haven't mentioned, the Russian invasion of Ukraine, the unrest in the Middle East. All these are having an impact as well, but definitely on the long-term outlook for inflation, but definitely the impacts from COVID and the supply side disruptions, it is going to take quite some time. Whether that's going to happen faster in South Africa for the rest of the world, I'm not sure, but I think we are going to see it for quite some time. And the markets, as we always say, my colleague Kyle always likes to say as well, the markets climb a wall of worry. There's always something to be worried about in the markets. And sometimes you really need to be worried, and other times you don't need to be worried. You need to differentiate between the two, and hopefully these Zen funds help people to do that. And then Derek is asking, how are the returns taxed annually? Short answer is I cannot answer that for you. I am uncertain. You obviously depend on individual circumstances, but I think you can speak to our call center, speak to your financial advisor, and they will be able to help you with that. And then Peter's asking a similar question on tax. Does the enhanced income fund returns attract CGT or just interest income? Well, depending on it, again, it's depending on your individual circumstances and what you're taking out of the fund. If you're taking units out the fund, you will potentially be liable for some CGT, but the income itself will be just taxed as income, but that's very much dependent on your own personal circumstances. And again, I'm not a tax expert whatsoever, so I could get that completely wrong. And then the final comment is from Alan D. Says, thanks for a great explanation of the enhanced income and Maximiser. Couldn't get from the fund fact sheets. Okay, well, that's not a real question, but thank you for that. Well, that's it. Thank you very much, everybody, for tuning in. We really appreciate that. And as always, we really appreciate your support. And we hope that these Sygnia ZenFunds, you can find a use for them in your portfolio. And if you have any questions, reach out to our call center, or as always, just speak to your financial advisor. But thank you very much.